think that in the back of our heads, back of a lot of our minds, we think we have a fair value model. What the stock market should be trading at, given the weakness of the economy, given the, what we'll find out to be 20% or higher unemployment levels, the social demonstrations that you talk about, a lot of things happening in the world, and yet the stock markets around the world continue to move higher. And why is that the case? And we're seeing how that's expressed in the currency markets, that rising stock market, is by the strength of sort of what we call high beta currencies, more volatile, more risky currencies. So for example, in the month of May, the Mexican peso was the strongest currency in the world. Not up just a little bit, it was up 9%. These are huge moves in the foreign exchange market. The strongest majors have been the currencies that, like the Australian dollar, the New Zealand dollar, the Canadian dollar. These also tend to benefit when people are happy to take on risk. So we have this fair value model, and yet the markets don't seem to be behaving as they should. So it tells me that there's got to be another force at work. And I look around, and what could that other force be to encourage investors to shrug off risk concerns, to shrug off the contractions in all the major economies? And the answer that I've come up with is liquidity. What's happened is all the major central banks, all the governments have spent money. Central banks cut interest rates, some by surprise. I think that the easing of monetary policy to such a large extent, coupled with the fiscal policies, spending more money, borrowing money, spending more money, that I think that this overrides macro concerns. And so what's happening is liquidity is sort of fueling risk appetites, lifting all the stock markets. And as we speak here today, there's two major markets that are up for the year. The US NASDAQ and the Chinese Shenzhen Composite. Two markets that are up on the year, which are more the speculative markets. Well, I suspect that the fundamental support will come soon. And by that, this week, as we start off the new month, we get purchasing managers' indexes. These are the first indicators of how the month of May went. And for the most part, they have surprised on the upside. Now, of course, the economy is still very weak. The Atlanta Fed says the U.S. economy is going to contract by over 50% at an annualized rate here in Q2. But the markets, one, are looking past that, and two, it looks like April and May is when the major economies bottomed. China looks like they bottomed a bit earlier, say 2 or 3 months earlier. But the Western Europe, the U.S. and Japan looks like they're bottoming now, say late Q2. The economies are going to catch up to prices, but prices are being lifted by this liquidity. And so when it seems to me that the more telling point about how long this could last for is what happens later this year, when some programs, some of the stimulus, like in the U.S. jobless benefits, the extended programs, last only till the end of July. What happens if they're not extended? So I think we could be facing a fiscal cliff that takes away some of this liquidity. And the same thing on monetary policy. At its peak, the Federal Reserve was buying $75 billion worth of treasuries every day. Now, they're buying $5 billion a day. And so we've seen other central banks, including Australia and Canada, also beginning to pull back or taper from how large of a program they were running in the heart of the crisis.